Hello and welcome, traders. Let's get into today's updates. All right, so I am on vacation this week, but I wanted to come to you today and just give you an update as to where we are. New all-time high in the portfolio today. Want to talk to you about strangles today as well. So we'll take a look at the whole portfolio. We'll take a look at some strangles and some different ideas around some strangles. And then we're also going to talk about some different trades and tweaking our strategy on strangles maybe a little bit. So let's get into it. Let's get to it and talk about what's going on. So first off, let's get into the account and let's just start there for the day since it was a great day in the account. Let me get myself off the screen. Hopefully I'm looking more tan than normal here today, but hey, even on vacation, the great thing about our style of trading is when you're trading 60, 90, and 120-day options, you don't have to be looking at stuff today. I happened to take 10 minutes, throw on 2 trades, and 1 trade came off by itself because it hit our profit target, and I already had a GTC order on there. So I really didn't have to do anything, didn't have to stop drinking my beer by the pool at all, just to make some trades. Let's talk about those and get into it. So let me get off the video here so you don't have to see me doing that. And let's talk about our delta today, down to 364 on the move on the session today. So 364 delta. Theta moving up again a little bit to 1714, which is 0.36%. So we're very delta neutral here. We've got great theta going 0.36. So we're very close to our 0.4% again that we typically look for in a little bit of a higher vol type of an environment to be in. So when vol's up a little bit, which it's really not, although you're maybe at 15 on the VIX. So when vol's up a little bit, then maybe we get a little bump in theta, but I like where we are. All right, from a net lick standpoint here, 480, 239, that is a new all-time high without us really having to do anything here. We did have a trade come off today, so 1960, we actually took off the naked puts of an oil 112. So that freed up some buying power. The naked puts of an oil 112 trade coming off, freed up some buying power. We put it to use by adding 2 more trades, and that's it. We're done. 10 minutes in, 10 minutes out, done for the day. This is the way to trade, okay? Stress-free, just letting yourself, letting your money work for you. Let your money work harder and allow the power of compounding, okay, to really do all of the work for you, especially if you have a longer term horizon. Talked about it a little bit yesterday, I think, in the session, where, hey, if you're in your 20s, you've got the power of compounding behind you. But even if you don't start in your 20s, it's still okay. If you can average, okay, and I'm going to jump off and jump back into video here for a minute. So let's just talk about compounding. And I shared this with the members today as well. But if you just start with a $10,000 account and you don't add any more money to it, but you simply can do what we're talking about here, which is 2% a month, not even 3, not 4, okay, just 2% a month. If you're at 2% a month, okay, and you do it for 10 years, you're going to have $1 million, okay? So that money is going to be worth over 1 million. So let me find the exact numbers on that while I'm talking to you today. So it's a pretty good opportunity for you to make money, okay, giving yourself the chance to let compounding interest do all of the work for you. All right, so let me see if I can find that info. If not, I can jump into the account. But again, we're not talking about craziness here, okay? We're just talking about simple compounding, 2% a month. Well, Tom, 2% a month is hard. It's not that difficult. We're not talking 5 to 10% like some of the furus on YouTube out there. I'm not talking crazy people day trading and scalping and doing all kinds of crazy stuff, okay, that can wipe your account out. We're just talking about slow methodologies here that can help you compound and put that money together. Right. So if you've got a $10,000 account, grow it at 2% a month, okay, it's going to turn into, $107,000. Okay. Pretty quickly. Okay. But in 20 years, you'd have 1.16 million. Okay. So 1.16 million, and that is never adding to it. $10,000, don't touch it. Okay, don't add to it, don't do anything. It's 107,000 in 10 years. But in 20 years, 1.16 million. Okay, that's never touching that account ever again. Okay, so one of the things I think that's critical for you, okay, is to make sure that you've got trades that are compounding themselves. Okay, leave the money in there, trade for income, but leave the money for growth. Okay, generate that 2% a month, and if you can maintain that, imagine what you're going to do if you're able to put some money in there. Imagine what you could do if you had a $20,000, a $50,000, a $100,000 account. Okay, in 10 years, you're a millionaire with $100,000 without ever putting another dime in there. Okay, let it compound, let it work for you. Okay, so a couple of things I wanted to talk about today, and let's go back to our account. So let me jump back into this with you. But I wanted to point that out today, that let your money compound. Okay, and you don't have to do crazy stuff, 5%, 10%. You don't have to be day trading and scalping and active trading and throwing trades on all over the place. All you got to do is generate 2% a month every single month. Stay consistent. Okay, don't take any big risks, and you're going to be in great shape. All right, so let's get back to that, and let's jump back into the account. Okay, so 480, 239 is where we ended up today. And I'll get off the screen again, so sorry about that. And we're sitting at 298 on BP usage, which is only 52% of the account being used when we take Bill out of the equation. And again, we booked $1,980 today. So overall for the month, we're up nicely $4,000. We have had hedge trades coming off. I mean, we've already spent almost $6,000 on hedges, almost $2,000 every single month. Okay, one of our hedges came off this month already. Okay, so we're up $4,000. It's only the 9th. Okay, and we're doing fantastic. In fact, for the year right now, we've generated over 13% on realized P&L, and we're up almost 13% on our net lick. While the S&P having a great year, S&P's up not quite 10%. We're up almost 13%. Okay, so we're out dueling the S&P, and we're way ahead of the 2% mandate. Okay, we're way ahead of that already, and we're only in the beginning of April. So we're only 3 months and a week into the year, up 13%, and we're really not taking outsized extraordinary risks. We're not shooting for 6, 7, 8, 9, 10% returns. We're keeping these things modest. I'm shooting for 3%. We're able to beat that most months. Last month was a little bit down because we had some strangles go against us. But other than that, 5%, 6.5%, then 1% last month. Okay. But overall, you're talking 13% for the year so far. Okay, without having to stress and be there in front of your computer. This is the way, in my opinion, it makes the most sense for you. Okay, but you got to have at least a little bit of a time horizon, and you have to just have something that's consistent and repeatable that's going to be able to generate that kind of return every single year. All right, so let's talk about some strangles today. And I'm going to share a little outline here that I put together. And I did some back testing, and I hope you can see this okay. But here's some back tests I did on 90 DTE strangles on SPY using my methodology of 7 delta puts and 6 delta calls. Okay. And I ran this pre-COVID from January 1st of 2019 all the way through the end of last month, those 3/31 of 24. Okay. So this is a pretty good study going back. And I did a couple different variations. So the first grouping here was I was looking at really a 1%, a 1x loss. Okay, a 2x stop, a 1x loss. What would work if I wanted to limit? And this is, we're starting to see, some people with strangles, getting tested on gold or copper, or maybe it was ES earlier in the year. Why? Because they're getting tested to the upside. Why? Because most of the time, what I'm seeing is people are not adhering to their trade plan, or they don't have a trade plan. Okay, you've got to have your plan so that you can achieve that retirement and let that compounding work for you. Okay, It makes no sense to have a plan if you're not going to follow it. And it absolutely makes no sense to just be winging out trades. These aren't even my trades. I'm not in gold strangles or copper strangles right now or ES strangles. Okay. I'm not even doing those. So I don't know where people are getting these ideas. Okay. And why people have 3 different strangles on gold or something right now. And what are you doing out there? Let me help you a little bit with this. Let's figure out the best way to go. Okay. Number 1, adhere to the doggone stop loss. If it's a 1x stop like these, fine. Okay. So which of these work better? Well, right here, this is a little bit better win rate. 86% win rate, taking profit at 25% and stopping at 100%. Okay. But the CAGR on this thing, okay, so your annual return, okay, is low. Why? Okay, you're just not going to get a lot of trades on. Okay, you're taking profit early, you're getting stopped out quickly. Okay, you're just not going to do well over time. Your average winner, $75, average loser, 284. Okay, so you lose 1, and it's going to wipe out 4 winners. Okay, so and that's how it should if you have a 4-to-1 stop to profit target. Okay, so didn't like that one. Okay, so this off the books. Okay, let's take a look at the next one. What's our annualized rate of returns here if we go to a 150 stop loss? Okay, both at 25% or 50%. Now the win rates, you can see here, the win rates have gone up. Right, so our win rates are going up. Why? Well, a couple reasons. Number 1 is because you have a little bit more of a loose stop. Okay, we're stopping at a 1x loss. Okay, so a 1x loss or a 2.5, 2.5x stop, which is a 1.5x loss. Okay, but you can still see down here that the annual returns over the period of time was not great on the 25, but on the 50, it wasn't bad. Okay, so the 50 to 150 here, 87% win rate with a 9, almost 10% annualized rate of return. Your average winner, $150. The average loser, $375, $379. This is not a bad trade at all. Okay, this is one of the more successful trades out there. Okay, can you improve on that by going to a 2x stop? Okay. Well, when we did this, looking at 25% profit, 2x loss, which was an 8-to-1, okay, you had a very, very high win rate. Okay, but your average your annual return was just not that great. 4 to 5%, because 75 on a win and then 48% on a loser. I mean, it's almost 7-to-1 ratio. Not great. Not going to get job done. 5,200. Okay, 90% win rate, and I have been able to prove that for years after year after year after year, because that's my methodology right here. This is the way I've been managing all of my trades. Okay, almost a 10% annual rate of return over time. Okay, again, 10% annual rate of return. Just let this thing compound. Okay, you're going to do really, really well with this particular strategy. 148 on the winner, 513 on the loser, which is a little bit over a 3-to-1, not quite 4-to-1 ratio, which is not bad. Okay, so if you lose 1, you're not wiping out 4, you're wiping out a little over 3.5 on this one. This is where I have been trading for years. And then we also looked at, what if we went to a 3x loss? Okay, your win rates will go up a little bit more each, simply because you're giving those trades more room to work. Okay, but again, on the 25% profit target, the annual rate of return is just not there. Okay, your couple losses are just going to wipe out a ton of winners. Okay, almost 9 winners get wiped out here. Looking at the 50%, 300, 92% win rate and a 10% CAGR, pretty similar to this. Your average winner was about the same as it was with the 200%, and your average loser was a little bit more. Okay, we originally were doing this a little bit because we had a better win rate for it, but I had backed it off because we found that you really can do better, okay, with the 5,200. So this is where we're really, that's where we've been focused. Okay, and then a couple bonus things here, and I wanted to throw these into the mix. So when doing some strangle testing, I looked at the 50-150, which is not a bad rate of return. It's not quite the win rate, but the CAGR is basically the same as the 50-200, okay? But your loser was much smaller, and the winner was actually about exactly the same, if not $1 more, okay? This trade, while a little bit less of a win rate and a little bit less of an annual rate of return, is probably going to make people a little bit happier because you're only losing, okay, essentially 2.5, not even 3 times. Okay, here. So here, your average loser was 3 times your wins. Okay, but in reality, we were probably closer to 4 when these were coming off. But that's pretty much it right there. Okay, this a little bit better from a loss standpoint, which I think what's frustrating most people with strangles is you lose 1 or 2 in a row, and it wipes out another 8, so you lose 2 out of 10 and it wiped out all other 8 that you had. Okay. You need to maintain that 90% win rate. Okay. That 90% win rate keeps you from, okay, if you lose 2, that's fine. But if you only lose 1 out of 10, well, 1 loss wipes out 4. That means you have 5 other winners. Okay. You've got great positive expectancy. Okay. But if you're getting frustrated with it, maybe look at the 50-150. And let's look at what happens if we introduce a little bit of technical analysis in here. And all I'm looking at here, because when I ran the same study using VIX, the results were terrible. Okay. IV didn't have any impact on the results. Okay. It actually made things worse. Okay. You had less trades. Okay. They weren't doing really well. So let's look at what did work well. And this is, again, using 90 DTE strangles on SPY, using my 7 and 6 there, but using that 150 methodology, which I kind of do like, and I might be starting to lean towards doing this a little bit more, probably because it's just the losses aren't as bad. You will stop out a little bit more frequently, 87 out of 90 win rate. Not a huge difference. You'll have a few more losers because you're not letting things expand. But for the most part, if you've got 150% loss, a lot of times those things aren't coming back. Okay. And look, the win rate is 3% different. So 3% of the time, though, going to 200, it can come back for a winner. So it's a pretty small rate. But look at what happens with the RSI. If you trade when the RSI is between 40 and 60, your win rate bumps up to 91.2 from 87. So you increase your win rate. Now your CAGR goes down, and the reason for this is much less trades. Okay, so you're not compounding over this period of time that we've been looking at here. So you're not winning and growing as much. You're not compounding over time like you would. Okay, you are going to take less trades, but your win rate is definitely going to go up. Okay, if you widen that just a fraction to the 35-65 here, your win rate still goes up over the 87. It goes up to almost 89, and your CAGR does go up. So to me, this gives you a little bit more flexibility. Okay? And your winners are still almost exactly the same, 154, and your losers are 407. This one looks pretty nice. Okay? I think that's a pretty good opportunity. Why RSI is because if you keep your RSI more towards the middle, you're going to be closer to the 21 EMA. My RSI is based upon that a bit. So I'm going to put myself in the middle of my 3 ATR, but with RSIs in the middle, you're probably closer to the 21-day moving average most of the time. Not all the time, some of the time. Okay. But if you keep it in the middle here and keep it in this range, and you're not trading when we're not talking, overbought or oversold. That would be 30 and 70 or 25 and 75, something like that. All right. This is keeping you from putting these trades on in an overbought situation. You're getting more trades on. Okay, I like it. We also looked at, what if we just took the 5200 that we're doing now and we popped that RSI into there? You do increase your win rate, and you just decrease your CAGR a bit here. This is what I've been doing for years. I just want to give you some insight as to why I really look at my trades with an RSI, and I really also look at trades that are close on the weekly. Okay, this is the daily RSI, but I'm talking, when I look at these, I look at the weekly charts. Right, and just for this year, just to give you some sense, let's put it all in one spot. Here's my strangles for the year so far. Right, so we have closed 22 strangles. 2 have been losers, 1 gold, 1 HG. They are what they are. Okay, and then you've got 20 winners here. Now these 2 losers have wiped out, you know, a chunk of these. Okay. And we have taken a few of these off a little bit early, which is really a no-no, but we've done it. But you've got, you know, a win rate of nearly, you know, 20 out of 22. I mean, that is a fantastic win rate. Okay? You're at 90% and change. Okay. The only thing that we've done here a little bit is we've closed a few early, which skewed the sums here. On it. So you can see that we closed maybe a few smaller trades. You got to keep them all sized the same so that when you do lose, it's only wiping out maybe 3 winners or so. But overall on the year, I'm still up $10,000. Okay? And that's really what I wanted to bring to your attention today is, okay, if you adhere to this, okay, you're going to be able to keep yourself in really, really good shape, okay, on strangles. But the 2 critical rules for strangles, really 3, is you got to have a plan for consistency. You can't willy-nilly put them on, then give it up, and then put them on, and then give it up. Okay? You got to stay consistent. Okay. So number 1, okay, you got to be consistently putting strangles on. Right now, I think I have 5, maybe 6. I just put on a new strangle trade today. We're actually sitting at 6 strangles right now. They are all sized almost identical. Okay. So for me, one the strangle is a little smaller than the rest. But they're almost within a couple $100 of themselves. They're all sized about the exact same. Okay. No matter what underlying I'm putting these on at, I'm running the same basic specs. Okay. Around 6 or 7 delta puts and calls. I'm going to take them off. I've been taking them off at 200x, or 200%, not 200x, at 200% loss. I'm going to tweak that down to 150 moving forward. Okay, I'm doing it too so that members don't get too discouraged with a large 2x loss. 1.5x still going to be decent, okay, but you can size these things properly. But if you size them all to the same and still have that 90% win rate, okay, then 1 loss only is going to wipe out 3 winners. Overall, you're going to have really great positive expectancy, and that's the key. But in order for positive expectancy to work, you have to be able to trade consistently. I've got 6 working right now. I've always got 4 or 5 or 6. I have 22 strangles that have come off already in 3 months. That means there's 7 strangles a month almost that are working. Some came off quickly, which is why I don't have as much income, is because some hit 20 or 30% in like 2 or 3 days, and I just took them off, okay, instead of letting them mature. Okay, so I did take a few off early because why not? I mean, if you make 10 or 20% in a couple days, why would you hold on for 50%? Except the one reason for that is to allow positive expectancy to work out. So you really want to get that full boat of profit off of that, because if you do have a loss and you're taking things off early, it's going to mess you up. But so you do have to stay consistent, but we took some trades off. It's all good. I don't mind it. Doing that because I feel I'm pretty comfortable with doing what you want. So number 1, stay consistent, put plenty of trades on. 2, you've got to size them all the same. Okay? You can't have some of these, being 4 contracts and some being 1 or 2. Whatever underlying you have. For me, I'm sizing them to about a $3,000 income. So if it's a 2x loss, it was a $6,000 loss or a $1,500 win. Okay, that makes sense. Okay, now I'm going to tweak those a little bit. So we'll get back to the 150%, but I hope this makes sense. Okay, I want you to put together a trading strategy that makes sense for you, but you have to hit your stop losses. You can't expect that, oh, it's just going to revert back. It's overbought. Stuff can stay overbought longer than you could stay solvent. So once you put those trades on, make sure that You stay consistent with everything that you're doing. Good luck in trading, and we'll see you guys tomorrow. Bye-bye.